Good afternoon, everyone. Before we get started today, just need to go through a couple of the housekeeping rules and cover those things off. All information herein is confidential and must not be reproduced without the consent of Apostle Funds Management. You should be aware that any information is general in nature, does not take into account your personal objectives, financial situations, or needs. Thanks for everyone for joining. My name is Daniel Sharp and I'm the Sales Director at Apostle Funds Management, which provides distribution for the Dundas Global Equities Fund. Today I'm joined by Alan McFarlane and Neil Sullivan from the Dundas investment team. I'm sure many of you may have some questions throughout this update, and if you do, feel free to go to the bottom of the Zoom meeting and post your questions through the Q&A through there, and then we'll get to answer them at the end. I can see a few more people still joining, so maybe we'll give it a couple more minutes and then hand it over to Neil to kick it off. Let's go for it, Neil.
Okay. Good afternoon, everybody, and good morning from sunny Edinburgh. Just want to talk through what we will go through this afternoon. So firstly, I'll give you a little bit of introduction to myself. So I'm a partner at Dundas, and I have responsibility for clients, and I stand a little apart from the investment team. And part of my job is to make sure we say what we or we do what we say we do. So part of today is I am going to take a bit of a higher view and remind you all about our philosophy and some of the key statistics and our report card really around that philosophy to make sure that that we are doing what we say. Alan will then follow up with more detail about the portfolio and the stocks and reports from the investment team. So if you can really consider us really as a, if I'm the telescope today, Alan is the microscope. So firstly, the philosophy, which I'm sure we have explained to many of you over the past, but it's always worth going through again. So this philosophy is set up to stand the test of time of inflation, of rallies, of pandemics, of different US presidents and all the issues of the day. And we believe, so when the firm was started, long-term investing was at the very, very core of what we do. So if I just quickly run through these points, and then what I'm going to do is make reference of these through a series of slides. So first one, aligned with the biggest factors driving long-term return. So I'm going to show you one slide that we often show from MSCI and a study that they have done for the Sovereign Wealth Fund of Norway, which is the largest fund in the world. And what they were looking at is the componentry of total return. So what we'll do is we'll take a little bit of a deeper dive with that, but fair to say we have been focusing on dividend growth as a key element of that long-term return. The second part is when you're looking for long-term return, and I think there's probably one word missing from number 2, is the word sustainable. So sustainable dividend growth comes from high quality companies with good capital allocation. And that really gets to the heart of everything at Dundas. So really what we're looking at is we're analysing these businesses in detail, which we'll hear more from Alan, and ensuring and analysing that those boards are making the appropriate decisions to make sure that they can grow those dividends going forward. It's growing their business. I mean, first and foremost, they're growing their business, which will allow them in turn to grow their dividend. The third thing is really the observation around how does this strategy perform? So markets go up, markets go down, we accept that. We don't change during those. We're not trying to capture a bit of upside and a bit of downside and trying to adjust the portfolio accordingly with what the issues or the macro issues of the day are. What we believe is we are buying stocks for the long term to see that come through. So we'll talk through a little bit about our upside downside numbers. And then the final thing is, when doing all of that, what we find is that the governance will play a key part of that. So if we talk about ESG, let's start at governance. So strong governance decisions will allow is almost a prerequisite to achieve all the things above that. Environmental and social, we would argue, is just part of governance. But again, we've got good scores in there. So if you were to look at our portfolio and say Morningstar or MSCI, it scores very highly. Okay, so let's move on. If we can just move on to the next slide. So this is the MSCI study that I mentioned earlier. And really what I'd like to show you, and what this pretty simple image is showing is, well, let's take the 1 year. Let's start on the left and go to the right. So what that's saying is over a period of, so in this case in the study, 94 to 2015, what this shows is the breakdown, and this rarely changes if you look at over longer periods. So what you'll see is the dividend yield, i.e. how much is paid out from all the companies, accounts for about 11% of total return on any of those given years. So that is the average over all those individual years. The next part, 38%, is the dividend growth. So that's dividend growth as those fundamental numbers of the dividends increasing accounts for about 38% of return. And 51% of that is coming from valuation. So the daily moves and the market deciding that they prefer this stock than that stock, the weight of money, the over-traded stocks, all phrases like that will apply to the valuation. So it's quite difficult. So looking over 1 year periods can be quite tricky. As you look over longer periods, what you see is dividend growth, particularly that maroon bar, becomes larger and larger. And up to the point of 20-year horizons, the dividend yield plus the dividend growth equals 93%. So valuation plays a very, very small part. So for us, we focused on the maroon bar, and really what I'll show you is some of the results of what happens when you do that. So effectively, what we've tried to say is that dividend growth, we understand the large componentry over longer periods, and what happens when you focus on that. Okay, if we just move forward one. So what we see here is our return page. So we never start from the left and go right. We tend to start from the right and go left. So what is important to us is the longest term returns. Okay, so so in that chart earlier, the important thing is we see these returns coming through. So what does this tell you? Well, I don't know. So what I would say is 13.5%. That's pretty good return. If you were to look at long run equity returns, that's ahead. And then if you go along to the left, you'll see all the other ones are looking pretty healthy as well. So we are very buoyed by those returns and obviously the relatives of those. We don't spend a lot of time looking at relative returns. We are looking at those underlying businesses. We are a stock picking firm, and it all comes from the bottom up. If I'll make one reference, I suppose, pandemic, we have to talk about the pandemic. So looking over the last 18 months is probably pretty symptomatic of Dundas. So what you see, so for the start of 2020, we had the drop from Valentine's Day to March the 23rd, and those drops happen from time to time, and they are pretty severe. And pleased to say that our performance came through that very well. Moving forward, there was a rally, so many people would call that value rallies. Many stocks started to rise with the hope of vaccines coming in, and we were a little bit behind there. But then, as you've seen for this year and for the quarter to date, sorry, the last quarter, then what you'll see is again a bit of an outperformance. So all quite pleasing. We just move to the next slide, thanks. And this is where the rubber hits the road. So what we're showing here is our upside downside capture numbers. So as markets go up, as I said, so pretty consistent around from 101 to 103. That's a pretty tight banding. So what we're showing is as markets increase, we are following that. But the main thing, the most important thing for Dundas is that defensive nature of our portfolio, and you see when downside events happen, you see those statistics coming through. So very pleased with those numbers. Okay, move on one more. Okay, so explaining dividend growth and dividend growth being the most important thing to us. So our daily task is to make sure that we can find that, and that companies are set up for that sustainable dividend growth. And then we look at the share price. We look at the share price afterwards. So that is the one that comes last. Our belief is that where dividends go, share prices follow. And what you will see is that underlying performance coming through over time. So what do we see here? So dividend growth for our portfolio, 10.1, backed by earnings growth at 8.6, and then shown a total return of 13. This is shown in US dollars. We do this analysis in US dollars, bring everything back to the one, I suppose, world currency, just because when putting it into some of the other currencies can distort it slightly. If we compare that to the index, so 3.2 dividend growth for the index and an earnings growth of 2.3 and the total return of 11.9. So valuation gains, I'm sure everybody, I don't need to tell you all about that, and to explain the growth in the index and the valuation gains in the index over the past, well, certainly 10 years has been quite significant. Okay, if we move on one more slide, thank you. Okay, so this, all I've done is then brought that last slide back and shown it in the form of the MSCI study since our inception. So you see that 10.1, what I've then added to that is the average yield for the portfolio over that period, i.e. how much has been paid out. And then you'll see the valuation impact for ours and the residuals in there showing as 0.9. So that's, if one of the roles of my job is to deliver, to ensure that we are delivering what we say we're delivering, that looks like a Dundas portfolio to me. So delighted with that 93% backing of our total return from those underlying fundamentals. And as I said before, that the index shows a slightly different picture. Okay, move on one. So the MSCI study talks about period of time. So it talked about 1 year periods. It talked about, well, in the study it had 10 and 20. So for our strategy, I've then taken the same information and applied it for the last year, for the last 3 years, and the last 5 years. So this happens, and if the advice for anyone investing in our fund is we're not for everyone. We're not a 1 year investment. We are not a short-term investment. To invest with Dundas and to get the best out of us is you invest for the long term. And we hope that you and your clients managing longer term assets, then what you would see is our strategy coming through and being able to navigate some of those sort of difficult times and good times as well as those come through. So whether that's a new US president, whether it's a rally, whether it's all of the issues of the day, then what we will see is we hope that the dividend growth is our true north that will take us where we need to be with our total return. If we move on one more, I wanted to just show this. This is the equivalent numbers for the index, and obviously valuation gain has been a huge part of that. But again, to just put that into context so that you get a full idea. So it really is just trying to bring that MSCI study to life, so you understand where the dividend growth is coming in as part of that. Okay, one more. Okay, so a lot of numbers on this page, but this is a calculation that's very important for Dundas. So really what I've shown you is the past, okay? And part of what we've got to do is go to the future, and that's sustainable growth. So we'd call this our Dundas ratio. You'll see half of it is the DuPont ratio and the breakdown of the return of equity. So what you see is net income as a percentage of sales times asset turnover times our financial leverage will give you your return on equity. We then, that return on equity, when multiplied by the retention rate. Now, the retention rate is 1 less the payout ratio. So what if companies are distributing more of their profits and paying that out in income, i.e. typically higher yielding stocks, then they've got less money to reinvest for the future. We are different to that, and probably when the biggest misconception of Dundas is whenever we use the word dividend, people assume a higher yield. We are a lower yield in the market, and that a large part of that is because that retention rate is reinvesting those profits for the future. So what you'll see is we have higher returns on equity, higher retention rates, and that's what gives us an implied growth rate. Now, what in terms of those numbers, so you look at us against the index, there's a premium of 3.5%. That varies, but not very much in the history of Dundas. So this has been a great guide for us in looking forward, and this is a key portfolio management tool when deciding any new stocks or any stocks to come out of the portfolio. Is we are looking at this to make sure any new stock is being accretive to the portfolio and improving that implied growth rate. And the important thing is the sustainability of that. So what you see on that first column is one of the most important. So the margins that we have in our businesses are strong and stable. So that's, sorry, I sounded like a Tory MP there. The stability of those margin numbers are a key thing to getting that return on equity. So looking at another way, that retention rate, that reinvestment rate into already profitable businesses is the real engine behind the portfolio. And with that, I will pass on to my colleague, Alan.
Thank you, Neil. Thank you very much. Good afternoon, everybody. Apologies, I sound a little bit bunged up. It's because I'm a little bit bunged up. So if we go on to the next slide, what I'm going to do is just address some data about the stocks in the portfolio, talk about some features of them. I'm very happy to take questions. I'm happier to take questions. It's not that early in the morning, but it's easier to get going playing returns rather than knocking the ball off the tee. So mixed metaphor, sorry. This is just about dividends in the second quarter of the year. And rather than dwell on the numbers individually, some of them are very interesting. Let's talk about what they're telling us in general. We all know the recent history. Last year, we entered lockdown in various guises around the world in the major economies sometime around March. Remained so to the collapse of the travel and tourism industry worldwide and a number of others. On the other hand, other industries had to adapt very quickly. Others saw tremendous demand on their services, notably one of the ones we're using just now, which is Zoom. So we entered a turmoil. We entered terra incognito. It was off the map. We didn't know who we were, and people had to run around very quickly and find answers. Many companies couldn't pay dividends. Some companies could, but were discouraged by their governments. Some companies could, but decided not to, just in case things got worse instead of better. There was a range of reasons, but dividends were suppressed last year, in many cases simply to preserve cash. One of the things that's happening at the moment is we're getting a bounce back from some companies. And so Grifols at the top, which is a Spanish version of CSL in its core hematology business, or the blood fractional distillation business and the products that flow from that, plasma and others. That's a good example that Grifols reinstated its dividend and increased it a little bit, which is why you get 125%. Neil talked about sustainability. Let me make an heroic forecast that I am so confident cannot be wrong, that we can put money on it. That will not be repeated by Grifols. And there's a lot of that happening at the moment. I saw in the press, I'm just back from holiday, and I saw in the press that Royal Bank of Scotland, which we don't own, felt that conditions are going so well they could return some money to shareholders. And the reason for that was that they had provided against potential losses last year, which did not turn up. So the provision wasn't required, and so they were able to increase their dividends. But just going down the list, so OpenText is a Canadian-based software company that operates globally. It's got a very interesting strategy. That it's got a core business, which is to do with libraries and identifying items and holding that information in a way that it can be retrieved very quickly, which has other applications. But the other part open text business is that it buys up quite old software products, not the kind of software products that would be offered by a Salesforce or a Microsoft Office 365, but slightly stranded products where perhaps the company doesn't want to sustain them any longer. It's got some customers, very mature products, and open text weaves them together into a suite. So it's most of its business comes from its growth is acquired rather more than growing by customer demand. Baxter is some of you will know Baxter well. It's a US healthcare business. It operates globally. It's been through a number of restructurings over the last few years, but they sell a number of products into the blood treatment industry and blood testing industry. Costco, I believe there's Costco's in Australia, so I don't need to explain to you. Half the people on this call will have Costco cards, and so on down there. And these are very healthy, very encouraging dividend growth rates. And in every case, they're happening because the underlying business is improving. So I was just reading the press this morning, and in fact, as Neil was speaking, and the sad news about that young man dying in New South Wales, and a picture of one of the streets of Sydney deserted of people. And that pattern around the world of, what do we do with this? We're stuck at home. It can give you an impression that not much is going on, when in fact, large sections of the global economy have adapted so swiftly that their businesses are accelerating, not declining. And you can see that down through parts of the portfolio that's dividend growth. So let's flip on.
Before we move on, I have one question from the audience so far for you.
Perfect. In that case, let's not move on anywhere. We'll just do that. Good.
First one's from Danny. Interest rates have been falling during the recent time with, I guess, our performance. What are the expectations in a rising interest rate environment?
For what, football scores or? Look, interest rates have been falling since 1979, and interest rates had risen all the way through the post-war era. And those of you on this call who are either students of financial history or have been around long enough will know that US Treasury yields reached 16%, I think in 1980 or 1979. And what happened was that when I say we, I mean the developed economies just decided they couldn't put up with inflation because that interest rate was a reflection of how high consumer price inflation was. And central banks were given mandates to beat inflation. And one of the instruments they used was they pushed interest rates up to generate a high real rate to bear down on inflation. Now, they got lucky because the oil price cartel, OPEC, really lost its force. The computer revolution went from the mainframe to the personal computer. There's lots of reasons, but that 16% interest rate, we got down to 1.6% US 10-year Treasury yields, I don't know, a year ago or thereabouts. So Danny's question has got a lot of force because we've had 40 years of falling interest rates and falling inflation rates. Now, the reasons for both of those would take up more than this call, and frankly, would need more knowledge and insight than I've got. So the question is relevant because we worry, all of us worry, that discount rates will go up. Now, Neil showed you the extent to which the return on equity markets generally over the last 10 years has come from expanding valuations. Now, again, that's got two component parts. 10 years ago, we were still reeling from the crash. We didn't hit bottom until February 2009. And there was a bit of a recovery, but it went, things went sideways for a while. But one of the reasons that markets have been so strong is that valuations have expanded. And one of the reasons that happened is that interest rates fell. I have no idea whether interest rates are going up or not. And I'm not being facetious. There's no smart aleck in that remark. I really don't know. I can point you at some persuasive material that would suggest that with aging populations, the rise of the boomers shifting from being accumulators to being people who will consume their savings and therefore have a terrible fear of inflation, that cohort is bearing down on interest rates and that there's no, where's the demand for credit? And there are arguments on the other side, which are that we flirted with negative real rates. In fact, there's no question, we had negative real interest rates earlier this year because CPI numbers were higher than the yields that you were getting at the bank and on deposits. If you'll forgive me, the question for us is not what's the implications for markets. The question for us is what kind of stock should we own at any time? We're not fans of leverage. We're not, that comes from a bit of burned fingertips. It comes from watching companies use leverage as financial engineering to produce profit growth that is more illusory than substantial. So the kind of profit growth we like to see is the simplest kind. Costco sells more products from more stores every year, rather than, say, International Business Machines that for the last 15 years that's tried to generate earnings per share by shrinking the number of shares, by borrowing money to buy back its shares. So we have an aversion, not an absolute aversion, but a significant aversion to leverage, which means that as far as our portfolio is concerned, rising interest rates would not be as negative for them as it would be for highly leveraged companies. And a lot of them, the private equity sector, that's the underpinning of the whole private equity movement. Could be good for banks because they've been asphyxiating on declining net interest margins. So the gap between what they pay you for your deposit and what they can charge someone for the loan, those margins used to be 3%. They declined to 2%. I think for most Australian banks now, they are 2 or less, 2 or lower. And that has been a horrific problem for the banking sector. The Royal Commission was bad. The mis-selling was bad. All the follies of the self-satisfied who ran many of the banks up to 10 or 15 years ago, and in some cases more recently, all of those were bad. But the real problem was the lack of pricing power in the lending game. And higher interest rates would help. Now, the reason that I'm running through all of this is those are the things that are in our minds. So when we come to look at stocks, all of that is brought into the meeting and all of that is brought into the discussion. And the balance of this portfolio, as Neil showed you, and I can test you all by asking you what the fourth number along in the left-hand column was on his penultimate page. But what it said was we have less leverage in the portfolio, financial leverage, than is the case for the wider equity market. In a period of rising interest rates, I lived through the 1970s, and the UK, at one point, a UK government had to impose a 3-day working week because the economy was in such difficulties. So it's not nice. So Danny, you're right to be worried. But right now, I don't see it coming. And we talked about this in the first quarter when rates were rising. I don't see the big rise. That may be what I think, but the portfolio is positioned to cope with higher interest rates relative to benchmark. That is not a promise that equity prices our prices would not fall in rising interest rates. That is not undertaken. What is undertaken is that our lifeboat, the portfolio, we think would survive those choppy waters better than others who have high leverage, maybe speedboats that aren't as well equipped for those choppy waters. I hope that's useful.
Perfect. I haven't got any additional questions yet.
Okay, so what we're looking at here is what stocks went up and what went down. That's about, it's so short term that you have to take it with that in mind. So Neil really did give me a microscope here or a chronometer to measure things, or that amazing Norwegian chap that ran the 400 meters yesterday and knocked a second off the world record. We're measuring things in very short distances here as opposed to medal tables over the long run. All it means is that we've seen some big jumps. If you're looking for one that might stand out, and it is interesting, is Louis Vuitton Moet Hennessy, LVMH, and assembled and managed by Bernard Arnault, one of the world's richest men, but he assembled the company over the last 40 years. And Louis Vuitton, yes, it sells the bags, and Moet and Chandon is the champagne, and Hennessy is the cognac. But the company is now much bigger than that. And really, it's an assemblage of the finest in luxury goods. Now, they bought Tiffany in the last 12 months. We had looked at Tiffany and decided not to own it, but when we look at what Louis Vuitton's done, we liked it a lot. We thought that they could revive it, so we're very pleased to see that. They also bought a company called Belmond, that if any of you have been on the Orient Express train, they run that. Why single out Louis Vuitton? Because one of the things that was a challenge through the crash is a lot of their sales come from the travel and tourism business. So companies like Diageo that sell Johnny Walker whiskey, other companies that sell luxury goods, it's striking the amount of their business that depends on people flying through airports and going to hotels and resorts elsewhere in the world and spending money there. And that was problematic. So there's a good example of where where they found it difficult. But an underlying pattern, which I did notice last week in London, because we went to England on holiday and walked around London free of non-UK tourists. It was a little bit odd. But if you walk down Bond Street in London, which is where all the high couture and the jewelers are, so we found ourselves there just as tourists observing. People love that stuff. There's a desire for luxury goods, for the highest quality products. That's it's not irreversible. It's not unchanging. So there's changes in parts of the Swiss watch market. There's changes in parts of the luxury goods market. But the key thing in there is that the demand for these products and from people who can afford them appears to be exceptionally strong. And going back to the discussion of interest rates and my references to inflation, that is an area which seems, if you have the right product, it would appear you have almost infinite pricing power. So that there's a phrase called premiumization in the drinks business, and you can see it in others too, that part of the growth of these companies, and it applies to Louis Vuitton, part of the growth of these companies is unit demand for more Moët and Chandon. I will resist going into Freddie Mercury's song, but but the other feature of that is the price of the product and their capacity to manage it and the volumes they sell it in and to get that pricing power is quite something to behold. It's a different world from Costco, but it's fascinating to see the power of that and how that works to their advantage. Okay, next slide. What worked? We're always getting asked this. I have a slightly short fuse about it because over a quarter, you're recognizing what happened rather than measuring performance because of the flits and flows of the valuation changes. But what worked? Well, healthcare worked. And on that previous slide, there were two companies that we owned going into the pandemic. We did not buy them in the expectation of a pandemic arising. It had nothing to do with it, but it was happenstance and very happy happenstance, happy squared happenstance. And healthcare has been powerful. And the whole question of how governments and public authorities and how we spend our money on healthcare it is obviously under change, and questions about resilience and sustainability in those sectors. So one of the stocks we own that you saw on the previous page, Lonza, manufactures the Moderna vaccine, and I think it's not, if not the only manufacturer, it's the principal manufacturer. Industrials, the world's industrial sector is coming back with a roar at the moment. Not all of it, but most of it is coming back with a roar, and it's coming back with a roar with retooling underway in some of them. So we did some work recently on cars. We don't own any car companies. We have very little direct exposure to the car company supply chain. So why bother? Well, the answer is it remains one of the world's biggest industrial sectors and one of the biggest industrial employers. The revenues flowing through it are enormous. Whole industries are based on supplying it. And we all use them every single day, so they have a big influence. And we have, I think some of you may have heard us talk about our mosaic, which is our view of the world that we build stone by stone. It's like a picture at Pompeii that when it was uncovered, you could see how the Romans made these pictures from stone by stone. One of the things we discovered in the auto business, and you will see it yourselves, is the shift. There's two shifts underway in the car industry. One is electric vehicles, and the other is electronic development. Now, they sound as if they're the same thing. In fact, they're subtly different. There's no doubt that an all-electric vehicle has a higher amount of electronics in it compared to the equivalent internal combustion powered vehicle. But the internal combustion powered vehicles are consuming more and more electronic product. And they're consuming it for mapping services, just old-fashioned stuff like moving your seat. But now fuel management, head-up displays, driver assistance. We drove on that holiday last week, and there's quite a powerful driver assistance tool in my car that I've been reluctant to use, but I started using it. And actually, if you keep in theory, it could drive the car in straight lines, which I'm not that confident about it. But in fact, if you use it and keep your hands on the wheel, to my surprise, there is a bit of man-machine connection, and it does become more relaxing. There's a lot of computing power in that. There's a lot of optics in that to pick up what's going on around. There's a lot of technology. And one of the things that's happening in the industrial sector worldwide is retooling to support changes like that. Now, at the moment, aviation is moribund. There's not many aircraft being shipped, but yeah, that's been an interesting trend in the last year. Consumer discretionary is an area that we're not as involved in, and we're about to do a big piece of work. We're going to block out a fair chunk of the latter quarter of the year to have a good look around. So consumer discretionary, I mean, consumer staples are foodstuffs. Consumer discretionary would be Louis Vuitton. But in that area, and that's been a help. That's one of the reasons we did well there. But the final thing that I wanted to draw your attention to is that some of our best work has been in things we don't own. And we sold our last oil and gas stock about 2 years ago. I wasn't sure at the time. I wasn't sure. I was confident we should do it, but I wasn't certain and thought we might come back to it. But the way things are changing now and the lack of demand through this recession, obviously lack of demand from aviation, which is one of the biggest consumers of refined product, but also the change in investor preference and the shift in our energy supplies around the world. This industry has not had its sorrows to seek. I still think I'll see $300 per barrel oil before I give up working. But communication services, this is astonishing. Every single one of us, especially you lot over in Australia, I'm going to stick my neck out and say that Telstra probably has something to do with us being able to have this call. And we've had this extraordinary revolution so that we've had iPhones and mobile services and gaming services and a whole range of things that are using more and more bandwidth and more technology. And yet, the suppliers of the cabling, whether optic or metal, have struggled. And it's a fascinating case study in that if we had this conversation and somebody opened a box and told us how many mobile phones there would be in 2021 and what the amount of data traffic would be across the world's networks this year, if we'd known that 30 years ago, I would have had my hand up and said, let's look at Vodafone and Telstra. And it's just not happened. And you can see it in the numbers that a bit like the banks and the lack of net interest margin, the pricing power in that sector has been absent. So I could go on for a bit. We've got 5 minutes to go. Any questions, Daniel?
You're on mute, Dan.
I'll wait for the audience, but I guess in the meantime, during one of our previous conversations, it's probably even more relevant, was your views on the Chinese VIEs and the ADRs. I think as we're watching Tencent and Didi and a few others go the way that they're going, did you want to share some thoughts on that?
Yes, I mean, Neil said it should be governance. It shouldn't be ESG. It should be G. So if we'd been in the room when the acronym was coined, we'd have petitioned that it's GSE, governance, social, environmental. We are where we are. Most conversation dwells on energy and increasingly on labor practices, but governance is the key. And that's why Neil mentioned it about good governance in the first slide, because for us to get dividend growth as investors, We need companies that can organize themselves to sell their products or services, generate profit, keep reinvesting to grow the business, earn those profits. They're taxed by local authority, by governments, and then they pay a chunk of that out as dividends. The structures of the VIEs that you mentioned, the Chinese companies, where the Chinese government says there is no permission for foreign ownership of any kind in telecommunications and other activities in China. The VIE structures of Alibaba, Baidu, Tencent, and others were designed to get round that. And the result is that the companies in China are owned often by management. A company is set up offshore, British Virgin Islands or Cayman Islands, and enters into contracts and says, and that company, so the offshore company is called Alibaba, just as the domestic one's called Alibaba. And the contract says we will move profits and dividends and so on, and those companies list on the stock exchange. Now, if you read, and I understand it's a minority interest, but if you bother to read the annual report and accounts of these companies, nowhere can you have any reassurance that the listed company in America has any title whatsoever to any of the assets in China. Now, it was a good example of, I see no ships, and we went on and we believed these structures were valid and it was all fine. I remember going to a session in Edinburgh where a Tencent senior employee, when asked, obviously we can get money into China, how do you get it out? And he said, well, that's a bit more difficult. Fair enough. Tencent's growing rapidly. It needs to retain its profits in China to grow the business. But what's happened in the last few weeks last few months actually, with Chinese government's treatment of Jack Ma, Didi, I think the ride-hailing app, and then last few weeks they've just taken the listed educational companies and just taken them outside and shot them. I saw in the last couple of days that Tencent was deemed to be in the crosshairs because Chinese government officials had indicated that the computer gaming activity, where you buy an extra sword or an extra something in the middle of the game, that this was some kind of addictive substance for China's youth. Now, I'm happy to invest in addictive substances. We invest in Diageo that sells Johnny Walker. So let's not get high and mighty here. And I don't know anyone who's an alcoholic, and I've known friends who were, and it's a terrible thing, the damage done by cigarette smoking. So this isn't a moralistic comment. The comment rests on governance. We couldn't see a way to owning those companies because we couldn't see a way that those companies were governed in the interests of shareholders, and that the shareholders had title to the business. Louis Vuitton owns the stores. It owns the production units. Costco owns the wholesale centers. When you go to Costco and you buy goods and you take them out the door, you have title to them. And the Costco board has complete control over the revenues and cash flows, or the proceeds of the revenues and cash flows that they have. We just couldn't see a path to doing that. And that cost us in relative performance. ESG is a great idea. And one of the things that we're getting told a lot is that ESG portfolios perform better. So this is pain-free virtue. What's been the point of all those religions and philosophers, eh? But in the case of this, we're now getting the pain of the governance structure, where it was made clear that this was not like Costco, and you entered at your peril. And you entered at your peril that the rules would be changed on a whim. Now, that can happen in Western societies. I remember UK governments imposing windfall taxes on different things, and there was an argument with retrospection. Governments sometimes have to do that. This appears to be different. This appears to be the Chinese government making it clear that, as far as they're concerned, you might own shares overseas through this VIE structure, but the business is conducted in China, and we are in charge. I'm very impressed by the Communist Party of China's achievements in the last 30 years, deeply impressed. I'd rather not have them running my portfolio.
I haven't got any additional questions at the moment. Thanks very much for your time today, Alan and Neil. If anyone has any questions or would like any additional information, feel free to come through to our website at apostlefm.com. Yeah, it's all coming up on the screen now for you. Alternatively, it's available to invest either on the ASX via the ETF under the ticker ADEF, so that's Alpha Delta Echo Foxtrot, or you can participate through one of the platforms, including NetWealth and Hub24. Otherwise, yeah, feel free to reach out if you have any questions. Thanks very much for everybody's time, and have a good afternoon.
Thank you. Bye-bye.
Thanks, Dan.